So let me introduce the persons who will take part in the panel discussion. Mr. Benoit Anne from Société Générale Corporate and Investment Banking. Welcome to the stage. Please join us and take a seat. Mr. Simon Kiano Evans from ING. Welcome to the stage. Mr. Ebrahim Rahbari from Citi. Mrs. Caroline Grady from Deutsche Bank. Mrs. Gillian Edgeworth from UniCredit. Mr. Jim O'Neill from Goldman Sachs Asset Management. And Mr. Radoslav Boris from PKO Bank Polski. And the moderator of the discussion is Mr. Neil Buckley from Financial Times. The floor is yours, gentlemen. You may start the discussion.
Thanks very much indeed. I'd like to turn first of all to Radoslav Boris from PKO Bank Polski to talk about the Polish situation in some detail and explain to those who may be less familiar with the story of Poland how it is that this country has managed to prove so resilient in the last few years through the financial crisis. Also look at what opportunities there might be for Poland in the current situation and whether it can continue to be resilient in the face of an intensifying Eurozone crisis. Radoslav, over to you.
Thank you. Well, I think that the experience has shown that Poland has been quite resilient to the slowdown in Europe. And if you look at growth dynamics since 2008, we've got GDP growth averaged 3.5%. We didn't have a single quarter of GDP contraction. And if you look at real GDP level, it's about 11% above the 2008 level. And I think there are several factors that contributed to that resilience. I think most of them are structural, which means that they should remain in place, shielding Poland against external shocks in the future as well. It's not to say that we are completely immune to the global shocks, but it means that we are less sensitive than many other places. And those factors, I would single out three of them. One is the relatively small openness of the economy. If you compare to, for example, Hungary or Czech Republic, export to GDP ratio in Poland is about 40% against 80% in Hungary or Czech. This means that we are about half as sensitive to global growth as those two economies. And approximately 1 percentage point change in GDP growth in the Eurozone translates into about 1 percentage point change in Hungarian growth, but only half percentage point in Polish growth. So that's number one. And this is the factor that makes Polish economic cycle much smoother. Point number two is the flexible exchange rate regime, which proved to work as a very efficient shock absorber in Poland. Approximately 10% currency depreciation boosts growth in Poland by about 1 percentage point. So if you go back to 2009, we've got the currency depreciation by about 20%, which probably boosted growth by about 2 percentage points, offsetting quite a bit, actually the most of the shocks we've got from weaker demand from Europe, which on my estimates probably subtracted about 3 percentage points from Polish GDP growth. And thirdly, it's the relatively early stage of the financial sector development, which, for example, if you look at the level of the stock of mortgages, it's still about below 20% of GDP compared to about 50% of GDP in most European countries, which means that the private sector leverage is relatively low compared to other countries in the world, and this means also that the potential for organic growth for the financial industry is much bigger, and as a result, we didn't have what you have seen in other places especially in developed world. I mean the development of the sophisticated and what turned out to be toxic financial instruments that magnified problems in many places in the developed world. So these, I believe, are the factors that are the main factors of structural nature that contributed to Poland's resilience. I think most of them are in place, which means that we are probably going to be shielded against external shocks. As I said, it's not to say we are completely immune if we get the slowdown in the Eurozone, be it because of the problems in Greece or anything else. We are clearly going to be affected, but what I think this means is that any slowdown would be less than in our peers.
Radosław, thank you very much indeed. To broaden out the discussion of Poland and its place, I'd like to turn now to Benoit Anne from Société Générale to talk a bit about how Poland fits into the investor universe, investor perceptions of Poland, why they see it as a good place to invest, but also to look at the extent to which investors do or do not differentiate properly between Poland and other parts of Central and Eastern Europe. We have seen Poland be somewhat of a proxy for the region in the past. Is that still the situation, or is there a kind of decoupling going on?
Well, I must say, Poland is probably the shining star of the region, but almost by default. This is because every other country looks particularly in trouble, whether you look at the Czech Republic at the front line of the growth shock coming from the Eurozone, or you look at Hungary, which has to deal with all sorts of other problems. Romania has its own issue there, and obviously smaller countries like Serbia virtually on the verge of a currency crisis potentially there. All relative, of course, but Poland's got a lot of things to go for. Radek discussed the strong fundamentals. I totally share his view. There are other factors that I'd like to flag here. First of all, in terms of credibility of economic and financial policies, I think the track record of the Polish authorities is particularly strong. And in fact, we had a controversial illustration of that, controversial because maybe a few investors didn't understand the central bank quite recently, but to me this is a sign that the central bank knows what they're doing. They are the last standing inflation targeting central bank in the whole world, in fact. Seeing an inflation risk popping up in the context of strong growth picture, the central bank decided to raise its policy rate quite recently, which to many looked outrageous. But if you're a hardcore orthodox inflation targeter, that's the right thing to do. And guess what? I think there's probably going to be another hike in the pipeline pretty soon, because when you're an orthodox inflation targeter, you're not going to be stopping at just one single 25 basis point rate hike. That wouldn't be very credible. So if everything continues to go as well from the domestic picture standpoint, the central bank is probably going to go ahead with another hike. So that makes it quite interesting to look at. The fiscal picture is also particularly good. What I like about Poland is the quality of the fiscal adjustment is much higher than in a country like Hungary, for instance. It's not about the quantity of fiscal adjustment alone. The way you do it is also important, and Poland goes in the right way about it. Another factor is access to the IMF financing, which is quite important these days at times of turbulent times in global markets. Since we're going to be thinking a lot about football here, I would say from the standpoint of IMF access, Poland plays in the Champions League. Poland can virtually avert a proper balance of payments crisis, making a couple of phone calls to Washington, D.C. All right? In contrast, Hungary plays in the 3rd division with a goalkeeper that is not particularly good. So you have a different picture there. Hungary is struggling to negotiate an IMF program, was hoping to start negotiations, but we haven't seen that coming just as yet. So a totally different picture there. So a lot of resilience from the external vulnerability standpoint for Poland. You have a bit of a buffer there. Now, going back to your point, ironically, Poland is indeed victim of its own success. And in fact, probably being excessively penalized by markets right now. Why? Because Poland is the large market in the region and is become a proxy for being bearish tactically on the region. So if you look at the Polish zloty of the past few weeks, the fundamentals didn't matter and the Polish zloty performed as poorly as the foreign, which to me is a bit outrageous. But nonetheless, this is the hard reality of the region. Contagion risks are quite severe on the region, and Poland is not spared from that in the near term because the fundamentals don't really matter driving markets in the near term. That's the hard reality for the short term, but overall it looks much better than the neighbors.
Okay. Benoit, thanks very much for the investor perspective on Poland. I'd like to broaden out the discussion now into the extent to which other Central East European economies also are a kind of model, or maybe a model or not a model for Western Europe and the policy discussions that are taking place there. I'd like to turn to Caroline Grady from Deutsche Bank to start addressing that question, and also take a bit of a look at Romania, which is an important economy that we haven't mentioned much so far, but has a big program of privatizations coming up, which will be presented here tomorrow, I believe. Romania has gone through a very severe austerity program and come out the other side still alive and kicking. So, Caroline, perhaps you could tell us a bit more about that.